Hello, and welcome back to the Wallfacer podcast. Today's guest is Jeremiah Smith, co-founder and CEO of OpenCover. Jeremiah, welcome to the show.
Thanks for having me. Hey, Ryan.
Yeah, my pleasure, and thanks for doing this so early, your time as well. And I think there's a few ways we could kind of take the conversation today. Obviously, you guys just had a big product launch that we at Vaults.FYI were excited to be a part of. And so I'd love to spend most of the conversation talking about that today. Maybe as a starting point, for people who don't know what OpenCover is, can you walk us through a bit about the kind of founding story, what got you excited about insurance and crypto, and then everything kind of leading up to where we are today with covered vaults?
Sounds good. Yeah, so the way I usually describe OpenCover is that we specialize in DeFi risk transfer. So insurance is a regulated term, and you can't use it just for anything, but informally we do, DeFi insurance. We'll probably be using that word a lot today, but for most of the things we do, cover or risk transfer is the appropriate way to describe it. But essentially there are 6 different categories, broad categories of risk on chain, and we focus on protocol risk, which would include vault risk, for example, and transaction risk, which includes things like phishing, social engineering. We got into OpenCover, or we got into risk transfer really about 4 or 5 years ago. We were building the millionth DeFi for Normies app. So, something that looks like a fintech app, in fact, has kind of like a mullet, DeFi mullet as they call it, has DeFi in the back end to actually generate the yield. And as we were building this out in 2021, 2022, risk transfer, cover insurance was a big topic for us because we wanted to replicate what a lot of TradFi has, for example, in savings accounts where the government or someone would guarantee your deposits up to a certain amount. And in trying to find partners for that, we realized how sort of underdeveloped, I suppose, back then the space was, the DeFi insurance, DeFi risk transfer risk landscape was. And that's how we started working, for example, with Nexus Mutual, and how we ultimately realized that the biggest opportunity, the hardest problem to solve was actually DeFi insurance, DeFi risk transfer, better interfaces for DeFi / better on and off ramps, which have, I think, now actually been solved pretty much. And it's really funny because we pivoted fully to what became OpenCover, I suppose, about 4 years ago, knowing or thinking that there would be a ton of other teams working on these sort of fintech DeFi mullet apps that would need insurance. And, that's absolutely the case. We've seen like a ton of these products pop up in the last, year or so. And now we work with them and offer them these kinds of risk transfer capabilities. So that's really the one of the stories behind OpenCover.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built Vaults.FYI, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show. Interesting. Yeah, I think I actually missed some of that. So what was the focus of that kind of DeFi mullet app you were working on previously? I guess it was connecting to the, different yield sources that were available in 2021, 2022, which would have been very different than what we have today. But yeah, tell me a little bit more about that too.
Yeah. So we built something that really felt like a fintech app. It was awesome. So there were 2 buttons in the whole interface, right? Deposit and withdraw. So we made it as simple as possible to just go from sort of bank account to earning on chain in a self-custodial manner. That was our whole thing. And we, from a sort of user experience perspective, from a technology perspective, I think we succeeded quite well, or we were probably the most advanced app in that category. And I remember when we raised a seed for that back then, investors were like, oh, it's self-custodial, nobody cares. Like, how are you going to beat BlockFi, how are you going to beat Celsius? And we were like, no, you don't understand. This is how it's supposed to be done. It's self-custodial. The user stays in control, all of that. And not everyone, but many, I would say, were like, no, 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 you'll never win. Celsius is going to be like the next unicorn, and all of those sort of incumbents are going to win, and nobody cares about self-custody. And it's so funny because, of course, as a founder, I was using these different products just to understand their user experience and what they offered. And I, a year or two later, I received the bankruptcy letter, physical bankruptcy letter from Celsius, for example. I still have it somewhere. And it was just so funny that in the end, I guess we were proven right. And more from a just product perspective, I feel that we did reach the, I guess, holy grail of UX for DeFi products. We had users who self-onboarded to DeFi through our product who were in their 70s. And so we did manage to make it like super easy. The yield sources were, so it was a protocol called mstable, which used Aave v3. I don't even remember.
That might have been V2. Yeah, V2.
Probably V2. In the back. So it was a stablecoin yield protocol, basically, in advance of its time. So the head of growth, I think there is now head of growth at Morpho. And yeah, like it was super funny. I remember like ERC-466 coming out and like us trying to like make some noise around that. And it took years after that to really hit the mainstream. But long story short, that's what we eventually pivoted to just OpenCover and just focusing on the risk transfer piece.
Yeah, even thinking back to that period a bit and what made kind of the Celsiuses and BlockFis interesting, you could say, is that they generally were offering higher yields by sort of abstracting away actually all of the risk that they were, additional risk, you could say, that they were taking underneath, right? Maybe at that time they were kind of offering not guaranteed, but kind of more fixed rate looking product at around 7 or 8%, whatever it was then, compared to DeFi, which I think was in a similar place, maybe depending on what point in 2021, 2022 that was, where rates had really come down a lot. And so it was probably closer to 3, 4, kind of if you were lucky. And so it did make those non-custodial products a bit more challenging at that period specifically. It feels like some of where we are kind of in DeFi right now, and just the sentiment and kind of commentary is in that same place where there really feels like there's two kind of worlds of DeFi, right? And we, of course, track all of this across vaults.fyi, but on one end, you have the classic Aave v3, Morpho v1 type products. And on the other end of the spectrum, you have things that rely a lot more on sort of giving discretion over to a manager to take these higher risk strategies with your funds. I certainly would never make the comparison directly to something like Celsius or BlockFi because they're definitely not that at all. But there is still more transparency. But there is a little bit more of the black box element as well. I'm curious kind of how you almost, one, if you would agree with that at all. And then two, I guess from, like an insurance perspective, a risk transfer perspective as well, how you think about maybe insuring those two different groups. Like maybe to make this even kind of concrete, if you could go back in time and you had the opportunity to try and do some risk pricing on a Celsius or BlockFi, like what would that have looked like back then?
Yeah. So we probably would not have underwritten Celsius or BlockFi specifically because the strategies were kind of off-chain. It was like lending through Genesis and this kind of stuff. We really focused on chain risk. Like, the risk that did not exist really before this new infrastructure, before blockchain became a thing where you can transact and build financial services. So I think we wouldn't, in the same way that today we don't cover, credit risk, for example, like off-chain credit risk. We really focus on, smart contract risk, effectively, liquidation failures, Oracle manipulation, governance attacks, the new risks that don't really have off-chain yet, or, that the incumbents, the sort of traditional insurance, don't even know what to do with right now. That's more interesting because nobody's doing it, I guess. But yeah, so I think for DeFi yield, we're seeing a lot of looping coming into the landscape. Even folks like Stakehouse now have some vaults. I think they're not directly on the Morpho interface. They now have their own interface. We're seeing these new one level of complexity. Well, one level of complexity above strategies to try to earn higher yields. And I know that some folks basically think that the risk reward ratio on chain actually doesn't make sense. And you should just stick with, or just go with like treasuries or whatever, because if you need to factor in the risk, you're earning less. Your expected return is actually less on chain. I know Yearn as well. I think they posted something not too long ago about the Yearn $1 million prize, I think they call it, where they highlight something that we had also faced back in when we're focusing on yield, really, or like covered yield back in the day, which is the fact that there are arbitrage opportunities and you can get yield at sort of smaller scale, but the minute you're talking 100 million, a billion, the yields sort of compress, like they won't scale. That I remember. So it's much better today, but I remember back in the day, 2021 too, if you were going to do more than like if you're going to do 100 million, like there was nothing scaled to 100 million in a way that was like safe-ish and attractive. So I guess we still have some ways to go.
Yeah, absolutely. And I think we've certainly improved there. But still at the same time, I think if you look at many of the largest markets, they do still face that massive yield compression. I think there's probably a bunch of factors at play here. Maybe the one that stands out to me is that there is just a lack of good diversified collateral assets or assets to borrow against. Kind of on a lot of these networks today. I specifically kind of always look at Morpho on Base, where I believe at this point that is either as big as or very close to Morpho's mainnet instance. And there really is only one major collateral asset there today, which is the CBBTC USDC 86% LTV market. And if you go across all of the curators, they're effectively all allocating somewhere like 90 to 99% of capital in their respective vaults into that market. And, I kind of look around and it feels like that is maybe one of the meta challenges of how do you generate yield in these more, you could say, kind of constrained protocols where you can't do a 3x loop on some different network to generate yield. So yeah, something I guess we'll consistently be facing as an industry.
Yeah, and it's interesting because that large market on Base is basically the Coinbase users, right, borrowing against their Bitcoin. So
yeah, precisely.
So it's interesting because there the use case is, hey, I want to keep exposure to Bitcoin, and I want to sort of use my money immediately to do some stuff in the sort of off-chain world. So the interplay between on-chain and off-chain is always very interesting. But definitely, good job good job for Coinbase to have unlocked that. Like I forgot how much there is in that market right now, but I remember that they grew pretty fast.
Yeah, it's very large, very significant. So coming back to insurance a bit, before we get into the new product, I'm also kind of curious to almost frame the size of where we are today and kind of what the future opportunity looks like here as well. Specifically, I think, let me just actually take a quick look at our site. I think today on Vaults FYI, we track something like $80 billion worth of TVL across all of these different protocols. Actually $101 billion worth of TVL across all of the different protocols that we integrate. And just to compare a bit, what is the total size of insured or risk transferred capital in crypto today? Is it on this scale of tens of millions, hundreds of millions, billions? Like where are we?
So you're talking about how much on-chain risk is covered right now. So there's two parts to the answer, which is how much is covered on-chain with on-chain capital and how much is covered off-chain. And we don't have much visibility into the off-chain part because those will be like traditional insurers that are insuring usually small amounts of risk of on-chain risk. But I can tell you, let me just pull up Dune here. I can tell you about the on-chain one. Okay. So I would say it's probably about 50 to 60 million on-chain. Okay.
Got it.
The active cover amount has gone down significantly, but I would say in the last year it's been between 200 million and between 50 and 200 million. So it's still quite nascent. The main, so I don't know if you know Lloyd's of London, which is this special or the largest and oldest specialty insurance market in the world. And there's a protocol called Nexus Mutual, which is basically the on-chain version of that. And that's a good benchmark to look at, because most of the transactions, like most of the sort of underwriting, happens on that marketplace on-chain. And then you've got traditional players like Realm and Sotter, and it depends, if you're thinking custody as well, then there are quite a few others. But for pure on-chain risk, you also have off-chain players that do, smaller amounts, I would say, for on-chain risk. But yeah, so it's quite nascent still, which is
I would
interesting,
say,
because off-chain risk, like property, crime, all of that, it's, insurance is huge, and in fact it's pervasive, right? Like TradFi is held together by insurance. You can't fly a plane without insurance. You can't build a skyscraper, can't organize a conference without it. So it's quite interesting that in this very risky industry, it's still underdeveloped.
I mean, yeah, you said pretty nascent. I would say extremely nascent. I think, again, we don't track all of the TVL, but we track a good chunk. So just of the 100 billion we track, 50 million divided by 100 billion is what, 0.5%? I'm bad at mental math. No,
Yeah, so
even
less
less than that. Yes,
yeah.
it's a a tenth of a 0.5%.
Rounding error.
Yeah. So, and again, this is actually kind of what I'd love to focus on at the moment. I mean, no lead up to this question. Why is that?
So I think there's a historical reason to it. The historical reason is it's the same as any industry, right? When the first things that were built on chain were the primitives that made financial transactions possible, smart contracts, dexes, the immediate things that produce some sort of outcome and that make it interesting to at least experiment on chain. When the shipping industry, the first ships that were built were not insured as well. But when it became this huge industry and there was more and more money involved, then folks, and actually that's how modern insurance was born, folks started to think, oh, wait a minute, let's mutualize risk here, because it's not worth doing all these expeditions if, one ship sinks and all of a sudden you go bankrupt. It's much better to just lose, 5%, 10% of your wealth, but then be able to do another set of expeditions to rebuild it. So historically, I think folks have approached the on-chain world, DeFi, as a sort of like losing money is part of the game, right? You make a lot of money and sometimes you lose some money. And as long as you lose less money than you make, you're good, because you're still making more than you would in a savings account. So I think there's this whole, hey, that's just how it works. And the fact that insurance is not the first thing you build. You first need to build the underlying technology. And now we're reaching the point where some folks won't allocate as much or won't come on chain if there isn't risk transfer available. So that's just, I think, part of the natural way that things evolve. But the other side of it is just that it's extremely hard. If you have capital that is willing to underwrite, some protocol or some sort of yield strategy, you could also just use the yield strategy. The caveat to that is that insurance risk transfer is a leveraged business, right? Like you don't have $1 sitting somewhere for every dollar of risk you underwrite. You leverage that dollar. So I think in TradFi, it's in the order of 60x. And in right now on chain, I think it's more 20. You can go, or I think on Nexus you could go up to 20. So it's still more conservative, but there is the leverage factor that means that you can still make money because your dollar's working 20 times around. But I would say the difficulty in finding capital to take that risk is a big factor, and also the actual risk, because right, like you price things based on risk, not on the yield associated to that risk. So when the yields are low, less folks, like right now, for example, less folks purchase cover. And until the risk comes down, it's not, sometimes the intersection between what underwriters are willing to underwrite at and what folks are willing to purchase cover at, or the price, there's no intersection. So those are probably the two main reasons.
Yeah, you're hitting on kind of a perfect segue to some of the other things I wanted to get into. But so actually, at the time that you were working on the DeFi mullet app, I was working on a DeFi protocol called TrueFi, which was doing, basically uncollateralized lending to market makers on chain. Did 1.8 billion in originations during the period I was there. And then, at the end, Alameda happens. And, it's not like you get 20 million of defaults spread out over time. You get them all at once. However, I remember quite vividly while working on that, one of the things we were trying to implement was tranching, which I think you could say is kind of like some version of a risk transfer, right? You're transferring some risk from a general pool of capital into a junior tranche. And, we talked with a lot of the people also doing tranching around that time. There was Idle, really, I guess, was kind of the big one back then. And, now I actually feel like there's a bunch of new teams, trying to, launch tranching focused protocols. And I think the irony that I found back then was that it was really easy to find people that were interested in the junior tranche. It was significantly harder to find people that were interested in a senior tranche. And I remember even kind of also talking with folks from Maker around that time that were also working on several similar type of initiatives. And yeah, again, I just think the place we sit in crypto today is that there is a lot of risk-seeking capital. There is not a lot of, I don't know, I guess in the traditional realm, what would normally be banks or sovereigns or people who are interested in these lower risk type of opportunities. And I guess it's the same dynamic that kind of exists within insurance and crypto today, right? There's just less conservative return seeking folks to some extent.
And the argument is that the baseline of risk is just so much higher than that what we consider sort of, proportionally less risky is still in absolute terms way riskier than just putting your money into some T-bill.
Exactly. So yeah, I agree. I think there are lots of kind of structural and pricing type of challenges here. But yes, we can kind of segue a bit maybe into how this features into kind of your newest product release. So I guess before kind of covering the covered vaults, give me a bit of the history leading up to this moment. Like, what was OpenCover doing for the previous 2-3 years, and how has that informed this newest product launch?
So there's two verticals, as I mentioned, where we focus, which are quite different from a sort of how do you underwrite and how do you think about risk. That's protocol risk, which would include vault risk, and transaction risk. And so in the last couple of years, we're really focusing on protocol risk and those two verticals. For protocol risk, we try to make it, so one of the things your question before was, why isn't DeFi insurance informally, why doesn't it have more traction? And actually one of the other reasons is user experience. It's still something that typically you would go off platform for, that you would need to prepay, that you would need to manually track the renewal of. And so it adds all this extra overhead. And so, people like to focus on the main thing they do, and they don't like to be interrupted in their user journey so much. So what we were trying to do is address this user experience challenge as well. So we've done things like start offering cover on L2s when L2s were, there was this big push for L2s. We did things like integrations so that you could purchase directly in a dApp when you were opening a position cover at the same time, and you would just sort of add an extra transaction to your user flow. And we did that with some success. There's some protocols like VFAT, StakeDAO, CAP, who have those functionalities. So it's like a toggle where you can toggle cover on when you open a position. However, that didn't really solve the entire UX issue, because you still have to prepay and you still have to manually renew. And that actually becomes even more awkward, because you would have to come to us then to manually renew. It's not part of the main dApp. Anyway, but that's sort of what led us to covered vaults. But yeah, so on the transaction cover side, we created a product at Lloyd's of London. Actually, we did their innovation lab, as they call it. And about a year and a half ago, 2 years ago, we wanted to do transaction insurance effectively, because there are two ways that people lose money on chain, or two main ways. The first one is the protocol blows up, and the second one is you get scammed and you sign a transaction you shouldn't have. For example, Bybit, I think, is probably one of the largest examples there. And so we created an entire, detection engine and a way to lock underwriting capital and unlock it when we, lock it when we think a transaction is not going to cause a loss, and then unlock it when we see the actual transaction on chain and verify that no loss has happened. And so those are the two main verticals that we've been operating on. Obviously, transaction cover. So we're just entered a partnership with a large security company in the blockchain space, and we'll be talking, we'll be announcing that, I guess, as our next large launch. But so for covered vaults specifically, the things that we solve, or that new primitive solves, is the fact that having to go off platform basically to purchase protection, having to prepay for protection, which doesn't make sense, especially not in a vault, because you don't know how long you're going to be in the vault for. And that also means that renewals are, you shouldn't have to do renewals. So basically, we just have this always on cover that you pay for basically in a streaming fashion until you decide to withdraw from the underlying vault. I can talk about it more in detail if you.
Yeah, please. I'd love to hear more.
Yeah. Basically, covered vaults are meant to extend existing ERC 4626 and beyond actually vaults. So instead of doing actually what we did back in 2021, 2022, which is to try to create vaults that had cover baked in, changing the primary point of deposit for users and trying to get them to deposit with us instead of Morpho or something. We flipped the problem on its head and thought, okay, well, what if we just allow folks who deposit to any vault to add cover on top? And so that's the sort of fundamental hypothesis behind this new primitive. It's basically a way to stake vault shares from any supported vault and turn on cover the moment they get staked. So the user flow would be, hey, I go to Morpho, or I already have some Morpho positions, but I want to make sure that, I want to protect myself from something like the USR fallout, which affected at least, I think, 10 or 15 vaults on Morpho and really recently. I want to make sure that even if that did happen, that doesn't affect me. I want to protect myself against bad debt, protocol failures. You can go and stake shares. Conceptually, you can go and stake shares, and basically the moment they are staked, you are covered. And then when you want to rebalance your underlying position, you unstake your shares, and they're back in Morpho, and you can do whatever you want with those positions. And so from a technical perspective, it's quite challenging, because you need to support all of these vault shares from different vaults. And so it means that we do need to deploy a new covered vault, as we're calling it, for every underlying yield vault we want to cover. But then also on the underwriting side, we need to manage the capacity, the underwriting capacity, so that we basically match whenever you stake your vault shares. We need to make sure that the entire TVL that's contained within that covered vault is backed by actual capital should there be a payout. So everything is sort of managed in the background. It's all auditable on chain. So you don't really need to trust us. You can just look at the covered vault TVL and then look at how much is backing it on Nexus Mutual, build this on top of Nexus Mutual. So it's all very sort of elegant from a user perspective, and it's all composable as well, properly composable, unlike the kind of things we were doing before, where you would have to sort of, you could start covering yourself in a composable way, but the minute you want to renew, you would have to come to us and then do an extra manual transaction. So here you just, it's like stake on stake to activate or deactivate cover effectively.
Yeah. I mean, to some extent, it's almost, you can think about it much more like, or I would think about it much more as the risk transfer is sort of now built into the product. Similar to like a lot of business, like take a SaaS business, for example, that, scales up as you scale up. It's kind of similar to this, right? You're not forced to purchase anything in advance, but as you generate yield, some percentage of that is deducted in order to pay for the insurance, essentially. Now, I do think that the one challenge that kind of still exists here is just the current rate environment and kind of what that premium essentially looks like here. Can you talk a bit through like how that dynamic improves over time? Like And maybe another way or a tougher way to ask this question is like, does insurance kind of only work in a higher rate environment, right? So like if a Morpho vault today is paying 4% and, insurance works out to about 2% of the APY, well, I mean, that sort of maybe breaks the model a bit. Like, are you sort of dependent on higher rates within crypto, or I should say like the ability to underwrite riskier and riskier things? How do you think?
Yeah. So it's very interesting because if you look at Aave, for example, a lot of folks park money there and they think that's the risk-free rate. Aave V3 I'm talking about, of course.
Of course.
And so already today, if you you can do like very easily do 3-4% covered, which would be higher than the risk-free Aave rate. And it's not like Aave hasn't, I think recently there was an Oracle issue, for example, where folks could have potentially lost some money. So it's not actually risk-free. So I think if you take just the pure sort of on-chain lens, even in the compressed yield environment we're in, there are some, as close as you can get basically to risk-free yield on DeFi that competitive with what is perceived to be risk-free yield on DeFi. But more to your point, what's going to happen is, I'm guessing anyway, the DeFi rates are going to, or the base rate in DeFi is going to be similar to the base rate like off-chain, right?
It should be. Yes.
Yeah. It's just a different like infrastructure. Yes, there's capital efficiency, programmability, you can seize arbitrage opportunities more efficiently and so on. But what's going to happen is the premiums are going to go down because there's going to be more historical data showing that, okay, well, this type of collateral, these smart contracts, these oracles work well. And you price the risk based on loss events, basically historical loss events. So the more historical data you have showing that things are safe, the cheaper you can underwrite them at. So I think what's going to happen is more, rates will, decrease or, like find some sort of like equilibrium on chain, but the premiums are going to decrease. And obviously there's also a cost for insurance off chain. So we're probably going to be matching that as well. And the question is going to be for businesses like ours, how do you deliver that protection in a way that's DeFi native, like DeFi composable, or like, for example, Vault native, like we're doing with Vault cover or covered vaults.
Yes. Yeah. I mean, that, excuse me, that piece all makes sense to me. And yeah, like so many businesses in crypto, I think we're all trying to figure out like, how do the economics here kind of work, at a steady state where everyone can make, some money in this flow. So we're all learning as we go for sure. Okay, well, I've got a few other things I'd like to dig in a little bit more on, like just the structure and like maybe a few examples of how these payouts and such work in practice. I think you mentioned to me previously that with Resolv, for example, which today's we're recording on April 7th, so that happened about just 2, maybe 3 weeks ago at this point. You guys maybe had some people who are potential claimants, I think would be the right terminology there, as it's still being decided what's going to happen with RLP. But can you talk me through what protocols there were you insuring? Were you insuring Resolv or RLP directly? Like, how were you guys involved in that flow, and what's that looking to shape out?
Yeah. So we weren't insuring. So we had a DPEG cover listed for USR. No, but there weren't any active covers at the time of the DPEG. So we won't be making a payout on those. We have covered vaults. So the thing that's also tricky with on-chain risk transfer is that composability is a double-edged sword. It's awesome because you have all these money Legos that you can make function together. However, it also creates contagion risk, like we've seen, for example, with USR depegging, right? Like the folks in Morpho, or some of the folks in Morpho who will likely be impacted, potentially did not even know that they had exposure to RLP. Because as far as they're concerned, they're in a vault. There's multiple collateral assets. They don't really care because the vault's supposed to liquidate the assets when prices go down. And the issue is that it was not possible to do that with USR/RLP based assets. So where our users are potentially impacted is on covered vaults. We have a covered vault which is exposed to RLP, and so unless what's missing from the vault, I guess, is returned through by Resolv somehow, we will be looking at making a payout. I think the xUSD, which is like November,
Mm-hmm.
I can walk you through that, which is a more,
Please.
like
Yeah, that'd be great.
like end-to-end example. So there it was very interesting as well, because we were not directly, there was no DPEG cover for xUSD, Stream Finance xUSD, because we sort of knew that it was, or we didn't want to underwrite it directly because we didn't think it was, we thought the premium would be too high for the risk involved. But we had folks who were in, say, yield aggregators like Beefy, right, like Harvest, and they were exposed again, like they were in a vault that was basically farming some underlying strategies or some underlying vaults that had as part of their strategy a lending protocol which had a market where xUSD was a collateral asset. So those folks definitely didn't know, or most of them definitely didn't know, that they were exposed to xUSD. What they found one day is that they were not able to withdraw from their yield aggregator vault. So that's exactly when you want to pay out, right? Like that's exactly why cover exists, right? And so there, what we did, there were, I think, about 10 or so folks who had purchased cover on those yield aggregator vaults. And we basically, you wait 14 days there's like a cool down period to assess whether the loss is final and also how much the loss is for. And then so we had underwritten all of these on Nexus Mutual. So we basically took all of those covers, and like every single basically cover you would purchase through OpenCover. This was just regular protocol cover at that stage. You basically get an NFT that proves that you're covered. And basically just take those and go to Nexus Mutual and show what's backing those covers, and then do a claim process. And you've got claim assessors on Nexus Mutual which verify that indeed these are valid claims. And since they were, everybody got paid out, and folks were quite happy. We published some testimonials afterwards, but it was, compared to traditional insurance, I would say it was pretty smooth. I think it helps that everything's on chain and it's quite objective. It's not like when your roof starts leaking and the insurance company's like, oh, but no, that's like wear and tear. And you're like, but wait a minute, like I have house insurance. This is like, hey, folks have lost money. Here's the transaction. It's totally objective. And, the policy is obviously, written in a way where there can be no misinterpretation. And so, it's a relatively straightforward process, I would say.
Something, you've just sort of spurred for me as I'm kind of sitting here and thinking is, as you're underwriting, say, a Morpho vault, for example, how often are you re-underwriting that risk? Are you doing that, for example, every time the allocations move around between different markets, or a manager brings in a new type of collateral? What does that process actually look like?
Yeah. So you would price, so basically the way you price a Morpho vault is that so obviously there's some base level of risk on just the Morpho, smart contracts. Although those, at least pre-vaults V2, are pretty well understood and battle tested. But then you look at the collateral assets, or like the different markets and the different collateral assets there, and the oracles. And obviously, and this is where insurance comes in as well, like you can't do it perfectly all the time. Mm-hmm. So you do, you take a snapshot of like, okay, this is what the collateral assets have looked like, and this is, the different curators will say this is like a prime vault, this is a high yield vault. And so there's a sort of risk category that the curator themselves sort of associate with the different vaults. And so based on those things, you would basically price the vault, and then there might be a change in collateral assets, and you'd have to periodically sort of decide whether or not the vault fits into your definition of the risk category that's within a certain price band. But it's not perfect, and that is where actually payouts are more likely to happen. But that's part of the game when you're an underwriter. You have to take risk. Like that's what you're being paid for, right? Like risk transfer. So you try to track everything in real time or periodically, but ultimately when you tell the user you are covered on this vault, they are covered on that vault.
Yeah, very challenging. I'd say there's just so many kind of dynamics at play. And one of the things that a lot of people have been asking for recently is broader risk metrics and risk assessments that people can access.
Yeah.
And I've seen some conversation kind of focus on the people the people sharing these risk reviews or metrics should be removed from allocation or investment decisions. And that's felt actually kind of flawed to me because I guess my understanding from a little bit less on the insurance side, but more on like the what's the business of S&P and Moody's.
Mm.
You know, they are in such an enviable business because issuers have to get rated by them. If that was not a requirement, no one would get rated by S&P and Moody's, I'm sure of that. And that's kind of the dynamic that exists in crypto today. And I don't think we'll ever be in a place where issuers or protocols are forced to get rated by some sort of agency. And so to me, it actually makes a good sense that someone like OpenCover would be pretty well positioned to kind of have and devise what that framework of kind of risk rating for assets, for protocols, for multi-sig risk, et cetera, looks like. Is that something that checks out to you? Because you are essentially forced to underwrite and do your own internal assessment of all of these different protocols and assets.
So implicitly, there is already a rating because the price is the rating, right?
Correct.
Yeah, so rating is tough. And I know there's a lot of chat about it right now because of what happened with USR. And there are these different sort of rating systems that are popping up, right? Credora, I think Steakhouse has one. And what's I think tough there is that risk management is three pillars. It's risk assessment, it's risk mitigation, but it's also risk transfer. If somebody tells you, right, this is like a AA vault or this is a BB vault, what do you do with that? Okay, so maybe you'll allocate a little, like if you might do your own risk sort of management and allocate less to the vault that's rated lower or sort of higher risk, but still it's not a very, because everybody's rating things differently and because they are just ratings at the end of the day, like how much does it really help folks? And that's really why insurance exists. It's to really transfer the tail risk. Like you cannot eliminate tail risk no matter what you do. Risk is part of life. Where there is life, there's risk. And so really we are less interested, I guess, in ratings and more interested in actually transferring the risk because that's where the real heavy lift is.
Yeah, that makes sense. And I've also, we have a, we don't even call it a risk score, reputation score on vaults.fyi. We essentially take kind of the lendiness of these products, basically looking at the TVL secured over time as like a proxy to say, yes, Lido and Aave v3 are extremely safe. If they're the biggest honeypots that exist. And like, hey, it's a sanity check for me that if Lido, God forbid, were to be hacked, we'd probably have to fork the chain or something, right? It's that sort of structural. So, but yeah, again, I think all of these things are very imperfect. I didn't particularly see anyone that I would say, like even in the case of Resolv, I don't know that anyone caught what actually happened in Resolv at the end of the day, like some of this, multi-sig or key risk, rather than like, something structural with its collateral assets. As we're kind of coming up on time, I want to maybe get to one or two, closing out questions. One that I'd like to better understand is almost like the supply chain of underwriting and risk today. Someone enters a covered vault, Steakhouse vault on Morpho. They see that it's let's optimistically say 6% APY. They're paying 2% in, cover premium. But who's actually underwriting that? Like, I guess, you guys are doing the underwriting. Where is the capital coming from for the payouts? And I kind of want to get into a bit of like your relationship here with Nexus Mutual and the role that each of you play in this flow of insuring products.
Awesome. Yeah. So I guess it's important to understand what Nexus Mutual is. Nexus Mutual is like Lloyd's of London. I guess Nexus Mutual is a protocol that orchestrates different capital providers. Okay. And the point in having different capital providers is that you can build these towers of risk. So instead of having one capital provider take on 100% of the risk, you'll have, 5 capital providers take on 20% of the risk. And so when there's a large payout, the payout gets distributed across multiple pools of capital. And that means that you don't have, or it's less likely that a single capital provider would just sort of blow up and not be able to continue underwriting and create a less resilient system. And so the goal really of the Nexus Mutual protocol is to to orchestrate these different syndicates, as they call them, or like pools of capital to underwrite risks, to ensure solvency so that there's like guardrails at the protocol level to make sure that none of these capital providers can do anything that is very obviously sort of bad for solvency, and also make sure that all the leverage parameters are within checks, and also facilitate or enforce, I guess, claim payment decisions, and all of the, I'd say, the heavy lifting, the fundamental sort of underwriting layer. Okay, so the functionality is basically you bring a risk programmatically to Nexus Mutual, to this kind of risk marketplace. It gets automatically underwritten by different capital providers depending on the preferences, on the settings they've put into place beforehand. And then when there's a risk, you again open a claim on the protocol, and there's a sort of semi-automated procedure which is supervised / enforced by the protocol to make sure that valid claims do get paid out. And so the question is, well, how do these risks arrive on the marketplace? And that's part of what we do. So we are a capital provider. We are a syndicate on Nexus Mutual as well. So we take part in the underwriting and on that sort of layer of the protocol. And the interesting thing that I think we're doing is building all these primitives on top that sort of connect the user and ultimately transfer their risk on this marketplace. So if you think of a covered vault, for example, you have a vault share, you're a user, you have a vault share, you stake it in a covered vault that we've built, and then somehow that risk ends up on Nexus Mutual and it ends up being underwritten there. And if there's a payout, you would get there would be a path for you to get paid out. And so all of that extra infra, that primitive that's built on top is like what we did in this case. And so technically the way it works is that when somebody stakes vault shares on our covered vault, we look at whether we have enough capacity. So we will kind of pre-buy capacity on Nexus Mutual to back the covered vault. Okay, so say there's like 1 million in capacity and we're at 900 actual staked value in the vault. So we're fully backed, and that can be enforced, or the payouts can be enforced directly on Nexus Mutual. And then somebody comes in and stakes $200,000 worth of vault shares. So all of a sudden, and that's why actually it's an ERC 7540, it's an asynchronous process when you stake your vault shares to start cover on the vault. What we do is that in real time, we'll see that staking request. We'll be like, oh, we're short 100K here to be able to accept the staking request. And we will in real time go and purchase cover on Nexus Mutual. And that's the advantage of Nexus Mutual, is that it's this programmatic marketplace where you can bind risk, as they say, and we would just purchase, say, $300,000 or $200,000 of extra capacity, and then we will accept the staking request and deliver covered vault shares effectively to the end user, and then anyone can verify that we now have $1.1 million worth of value staked in this vault, and we have $1.2 million worth of actual cover on Nexus Mutual backing the deposits in case there is a payout.
Understood. So, I would kind of almost think of it as saying, hey, you guys are really like this sort of distribution engine for insurance in some respect, in that most people are kind of not going to go perhaps and navigate some of the complexity that may exist in Nexus Mutual today. And you're packaging it in this very simple to use product experience. And all of this messy stuff that's happening behind the scenes, you're saying, hey, user, you don't have to deal with this anymore. And let's try to make insurance or risk transfer into this very first class product experience.
Yeah. So if you think of sort of off-chain traditional insurance, there's two ways you buy it, right? You go to a website, or you would sort of write an email or call a broker. Okay. And so basically in both cases, there's stuff happening in the background. Obviously you want things to be composable on chain. So we don't have an option really, or I guess in some cases we can do it when it's very bespoke, but if you want stuff that's composable on chain, so the whole sort of like, I'm going to talk to a human being and look at some PDFs and sign and transfer some money, that's like off the table. And then also, even if you are using a website, if you want to bind on chain, there's a whole bunch of things that need to happen there. So so Nexus Mutual is this sort of like kind of like the the carrier in, like, if you buy car insurance online, for example, you will interface with the, like, in a way, the broking or the broking system and like user interface, and then you'll get a document at some point that says, here's the broker, but actually here's the carrier. This is where the risk is actually being placed. And so we're rebuilding that whole sort of on-chain native stack to be able to do that in a way that's composable in DeFi native.
Very cool. I mean, yeah, that's what a lot of us are doing, just sort of rebuilding things with better Rails. So I guess, one or two final questions as we're approaching time here. Something I feel like I kind of glossed over a bit, perhaps, is in the flow of someone taking their vault shares and staking them with you guys, that does introduce an additional smart contract into the flow. Who insures the insurers? Like, how do you think about that risk that a user, may be taking on as well?
So that's included. Our infrastructure, of course, is if anything goes wrong with it, that qualifies as an incident in the same way that if the actual yield vault that we're covering, suffers an incident. So there is extra risk in a way because there's an extra smart contract, but it's an ERC 7540. It's obviously been audited with,
yes,
I would add, 0 critical, 0 high, 0 mediums, both on Nethermind. We did a Nethermind audit, and we did also a Sherlock audit contest, and there also there was no highs and mediums. So, obviously everything's super audited, monitored, but it doesn't even matter because for the end user, if something would happen to our info or our contracts, it would be covered in exactly the same way as if something happened with the underlying vault.
Oh, that's great. Simple answer in that case. And then, my final question is really, tell me what a year from now, 2 years from now, success looks or feels like for OpenCover. Whether that's what's the, most important metric for you today, or however you want to take that question.
Yeah. So for us, it's really about embedded protection. Like we think that you basically need to give the option to users to transfer their risk. It's not just about, it's mostly about protecting users, but it's also about protecting ourselves, like as the, vault or sort of protocol builders. If you make the choice for the user not to offer any risk transfer, you are basically going to be faced with at least perceived liability. Like there was this tweet I read recently. It was a DeFi neobank founder that was talking about the risks that fintechs face when offering vaults to their users. Because there's this whole new trend now, which is not just like a DeFi mullet. It is, hey, I'm going to have like literally a neobank where folks are going to be able to provide liquidity into whatever vault to make higher returns than they would in a traditional sort of neobank setting. And the reality is, so this guy says, from a legal perspective, we are not liable if there is a loss on one of the vaults that we offer. But in practice, that position would be untenable. And we would probably have to pay out at least some, if not all, if it did happen. And I think that's really what we're faced as an industry. Like, there's no free lunch. We're not going to be able to say to the world, hey, guys, we've got better infrastructure. It's awesome. It works 99.999x% of the time. But when it doesn't, sorry, there's nothing we can do about it. It's just part of the game. I don't think that's going to work. At the same time, we need, like, if we're having an adult conversation about risk, like we're never going to get to zero risk. It just doesn't exist off chain. It's not going to exist on chain. So the best we can do is offer the option to folks to cover whether it's their vault positions, protocol positions, yield bearing stablecoin positions or transactions on chain. You have to be able to offer the risk transfer. And so that's what we're building. We're building a way for anything from wallets to sort of vault platforms, a way for them to offer this risk transfer to their users and hopefully onboard more users and also, decrease their perceived liability, if not their liability directly.
Well, that's a great and noble goal. So we'll be rooting for you. And please do Slack me that thread afterwards. I'd love to take a look at that. So, well, hey, thanks for all the time today. I hope everyone enjoyed this conversation on risk transfer, is excited to check out OpenCover's new products. We have them on vaults.fyi as well. I believe right now we're only showing BBQ USDC because we only show things on the front end that are over 100K, but definitely check that out. And as the rest of them continue to grow, we'll be showing those as well. So thanks for waking up so early and chatting today, Jeremiah. And we'll speak soon.
Awesome. Thanks, Ryan.
Thank you.